Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenivek on Bloomberg Radio.
Couple of stocks making big moves today. Shares of Apple fell as much as 7.3% earlier in the session. The stock on track for its biggest three-day sell-off in decades amid ongoing uncertainty about the Trump administration's tariff policies. Look, a lot can happen in the next 90 minutes, but that's how things were earlier today. Tesla shares fell as much as 10.5%, extending losses, dropping below a price at which Howard Lutnick, the Commerce Secretary, predicted they'd never fall to again. Dan Ives is watching these moves closely. He's global head of technology at Wedbush Securities. Yesterday, he cut his price targets on both of these stocks. He joins us here in the Bloomberg Businessweek studio. Dan, I want to start with Tesla because you are a longtime bull. I never thought I would see the day where you became bearish on the stock. But this weekend, you lowered your price target from $550 to $315. There are haircuts and there are haircuts. This is a big haircut. Why'd you do it?
I mean, there's two reasons. One, the political damage that Musk has self-inflicted between Doge and obviously everything we're seeing play out, along with the Trump administration, I believe it's destructed demand 20% in Europe, 10% in the U.S., and that could be conservative. And I think that's something that's also starting to show up in China, which is ultimately, look, if you look at our new estimates, it's really taking a huge haircut to what China growth is going to look like. The second thing is when you look at the tariff's a headwind. There's no way to sugarcoat it. And the reality that a U.S. car company makes cars in the U.S. with all U.S. parts, that's a fairy tale. That's a Pinocchio story. And I think for Tesla and for Musk, it's a moment of truth. Because you can't be 3% CEO, 97% Doge. And the brand issues, it's created Tesla into a political symbol. Mm-hmm. And that is a very, very bad thing. And I think it speaks to what's happened in the stock.
Do you see any hope that image could be turned around? And I ask that not so much in terms of what Musk can do, but maybe the question that investors are going to start having to ask is whether the company just needs new leadership altogether.
Look, I mean, in the next 4 to 6 weeks, he makes a choice. You step out of Doge, you literally now back to CEO of Tesla. He could still be some sort of, official, unofficial advisor, whatever it may be. But the reality is then the brand damage would be contained. It would be stitches, a black eye.
Will it, though? Because it's on him. I mean, it's not just people saying, oh, we think Tesla's a bad car. They're looking at the CEO and they're saying, we think you're, from not my words, you're a fascist, you're a Nazi. This is a taint that you just don't scrub off overnight.
And I don't think you scrub it all. There's no way that you scrub it all. Like you said, there's a permanent brand damage that's here. But here's the key. You continue down this road, then that permanent brand damage, it becomes something much bigger.
Yeah.
And the shame is that, and it's, look, the reason we kept the rating and didn't downgrade is because I believe, along with NVIDIA, two of the best disruptive technology companies in the world. Mm-hmm. But here's the thing, it's a fork in the road.
Like to borrow a phrase from him.
For Musk, now to make the right decision.
Maybe email him with that as the subject line and see if he replies. Hey, I do want to get to some breaking news. Apple plans to source more iPhones from India over tariffs. We're going to talk about that in just a minute. The Wall Street Journal is reporting that. I want to go back to Tesla, though, and talk about China a little bit. Xiaomi, BYD, the technology that those car companies have, among other car companies in China. You've spent a lot of time traveling around the world looking at this technology. Do Americans actually understand how innovative Chinese homegrown EVs are?
No. And actually, it almost speaks broader to even some of the issues that we talk about in terms of like tariffs, the concept that we can make things here in the U.S. Look, China, when you look on the EV side, I mean, China's really front and center.
Because that seems like a huge headwind for Tesla.
Well, especially when it comes to BYD in terms of, because think about it, right now, BYD, they're going after Europe, South America, aggressively going after the rest of the world. At a time where Tesla, this should be the time that it's go time, that you're going after the rest of the world. But the political damage, the brand damage that Musk has done, self-created, it's hurt that issue. So my whole point is that the longer term for Tesla, it's one of those moments where its future will be determined, a lot of it, how Musk handles the next 30, 60, 90 days.
But this is still a company that gets pretty much half of its revenue from outside of the United States. A big chunk of that was in China, at least based on the numbers at the end of last year. So if China goes, or at least it starts to wither to a much smaller percentage of sales, can he make up those sales anywhere else around the world? No.
No, I mean, that's why it's the hearts and lungs. There's no... and also, when you look at what's happened in China, and we've talked about it over the weekend, all the issues with tariffs and everything, China, what does it do? Drives buy more domestic, BYD over Tesla, Huawei over Apple. It speaks to the broader issue that a lot what's happened here is that the companies that take it most on the chin will be Tesla and Apple.
But with Tesla, just one last question on Tesla, though, what's the alternative? If I'm shopping for an electric vehicle, and this was the advantage Tesla had for years, really, was there really wasn't an alternative, and not a viable alternative. Now, I know there are a lot more vehicles out there, EV vehicles out there, but not necessarily at the scale of production that Tesla has.
No one could really even
or the
compete.
Pricing that Tesla has.
And look, but it speaks to what's so frustrating about what's going on. If this was Intel, look, these are disasters relative to okay, is it the stock, is it cheap or falling knife? Tesla, it's about the massive opportunity ahead. But what Musk is doing in terms of, it's a self-inflicted wound that needs stitches, now surgery, and that's our whole point. It's like, you got to make the decision.
Let's get to Apple. Shares of Apple right now are lower by about 4.2%. You cut your price target on the stock to $250 from $325. I want to start with the headline that we're getting from the Wall Street Journal. The company plans to source more iPhones from India as a potential fix for tariffs. A big part of your note has to do with exposure to China. Maybe in the first Trump administration, this would be news that investors would cheer because, okay, well, India hadn't been hit with tariffs. It was between the U.S. and China during the first Trump administration. With global tariffs, does anything matter?
But that's the whole... I mean, think about Vietnam. You move to Vietnam. Vietnam's worse than China. And then, like, when you talk about India, it would take years to even make that more than 5%, just given the logistics and the nature of India, in terms of as Apple tries to move some stuff there. Look, no company in the world is hurt more from once that came out of Trump's mouth in terms of Taiwan and China tariffs than Apple.
Yeah.
Because you're talking about 90% of iPhones are made in China. And the reality, and even over the weekend, well, we got to make it in the U.S. Here's the deal. If you want $3,500 iPhones, we should make them in New Jersey, maybe make them in California. If you like $1,000 iPhones, you make them in China. Well, and that's just the reality.
Well, it raises the question, too, is whether Apple really would try to move. I mean, do they have enough pricing power where if they have to raise the cost of an iPhone by 20, 30%, I mean, I don't know. They've convinced people somehow to pay $1,000 or more for it already.
But that'd be massive demand destruction. And look, and my whole point is that it would take tens of billions of dollars to even move 10% of the supply chain. That would take 3 years. So that's why the reality right now, what's going on in terms of tariffs and the reaction, investors look at it like it's untenable, and it would be an economic Armageddon to the U.S. tech industry. In my opinion, it would set U.S. tech industry back a decade.
Wow.
Do you think the White House understands the economic Armageddon?
Look, I think it's easy to stand in front of a microphone, and I get it. Politicians talk. The reality is when you spend time walking through fabs in Taiwan, Foxconn in terms of China, you spend time there and then you come here and you actually think, given our labor force, manufacturing costs of labor, that we're going to make that here. That is just, in my opinion, it's massively unrealistic. And that's why it just speaks to what's happening with stocks. Because investors, they're not, this has nothing to do with Republican, Democrat. Investors know math and the reality.
Yeah. And I'm kind of playing devil's advocate here, but with regards to Apple and its ability to find some transition through all of this, is there a way that they could maybe increase sales outside of the U.S.? And I bring that up because Tim Cook was just over there in China for that big meeting. He obviously toured a lot of other facilities and universities. For some reason or another, he seems to have a relatively decent relationship with the Chinese government.
10%
and
politician,
its economy.
90% CEO.
Yeah, and he's done it right. He navigated the first Trump administration, and I do wonder if maybe we're counting him out, that he might find a way to navigate through this.
Look, the $500 billion they announced, is that getting some sort of exemption here and there? Look, and that's something that like, investors are holding out for. But the reality is, if you want a body blow and an uppercut and cut the knees off of the, in my opinion, probably the best technology stalwart in the world in terms of Apple, this does it.
Wow.
Forgive me, Dan. I want to go back to Tesla because I'm getting a question from a viewer right now who says that Elon's brand damage has been evident for months. Why did you just downgrade the stock as a result of this?
No, it's a great question because I believe from everything we're seeing in Europe and the U.S. and deliveries going into 2Q, that it went from something that was containable, 5%, to something much broader. And I believe it was also our view that he'd hold the line, start to step back. Instead, he hasn't. So the point is that brand damage, when we model that out into 3Q and 4Q, that's us basically modeling out what we believe the brand damage is going to do to the next few quarters. And look, and I would also say like it's something where it's become a life of its own, and Tesla's become a political symbol, and it's a very unfortunate situation. But look, it's self-inflicted by Musk.
We're heading into earnings season. At some point, they're going to have to address investors directly. I think Tesla reports in mid-April, and then Apple not to May 1st. What do you think the CEOs and the CFOs, for that matter, can actually tell investors to sort of calm them down?
No company is going to give guidance, in my opinion, during earnings season. I'd be shocked if any company gives guidance. If you want to play blindfolded darts,
no.
Look, and I think the reality is, blindfolded darts actually is pretty fun. But beside the point, I think they're basically going to have to give some sort of guardrails.
Yeah. How
they're going about it, how are they scenario planning, and that because investors want to understand worst case, base case, best case.
Dan Ives, Global Head of Technology at Wedbush Securities. Thanks so much for coming in.
It's great to be here.
Good to see you.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I got the HCPI function on the Bloomberg terminal. Fell as much as 4.7% today. Rose as much as 3.4%. As we just heard from Charlie Pellet, we're down right now by about 0.4%. Lots of volatility, to say the least. And that's exactly why we wanted to talk to Eric Weiner. He's Bloomberg News Equities Team America's team leader. He's the author of several books, including What Goes Up, An Oral History of Wall Street from the Great Depression through the Internet Bubble and the 9/11 attacks. He joins us from just outside. Well, no, you're here today.
I'm here.
Oh my gosh, he's back with us. On Friday, he was remote, and we relied a lot on you, and we're doing that again because when you wrote that book, What Goes Up, that time span included Black Monday. A lot of people over the weekend, the chatter online was a little concerned that what we're going to see on Monday is going to look a little bit like what we saw in 1987. The volatility, yes. Maybe the massive crash, no.
I would say there was, in 87, there was a palpable sense of things coming unglued. And then on the Sunday before, well, it was the Saturday and the Sunday before, Treasury Secretary at the time, Jim Baker, came out and made a couple of remarks that really scared the market. So when you came in on Monday morning, when the traders came in on Monday morning, they were looking at it going, oh my God, things are going to blow up. Here, it was less clear. I mean, I remember I was looking at futures last night. They came down a lot, but they weren't down as much as, say, China was. So there wasn't this sense that, like, the U.S. was just going to bottom out. If anything, it was going to be, like, more of a global spread. So Black Monday was kind of a more predictable route. And then it had to be lifted out by the Fed. This was something where, it's kind of building.
What does that tell us then about the sell-off that we're in? If this is just gradually building, we don't have one Black Monday, does that mean
That's exactly it. So the concern, bizarrely, the concern is that things are actually moving fairly normally, which means we haven't hit a bottom, which means we aren't seeing panic or capitulation, whatever word you really want to use. What you are seeing is people desperately wanting the president to back off of tariffs. So as soon as that rumor hit, we went up, we moved, as you pointed out, 8 percentage points. So wham, swing up, and then it gets taken out because that's not exactly true. But there is a very simple cure. Like Black Monday there were systemic problems. There were people who were missing. Right. Yeah. There were people who were going to have, this is what I was watching for last night, was like margin calls.
Right.
And situations where big hedge funds had been caught off sides, weren't going to be able to make the payments. And now you have counterparties that are wondering where the money's going to come from. That is not the case now. They're just begging President Trump to get rid of the tariffs.
In other words, like you said on Friday, this is orderly.
This is orderly. And the orderliness of it is what's scary to market pros, because it's when things get disorderly, you sort of have that catharsis. We're still waiting for the catharsis.
Right. The
difference is that this was, and it's been pointed out by many, many Wall Street people other than me, that this is caused by one thing.
Exactly. And I think, one of the criticisms I see of this on TV, our markets guests we speak to outside of the building, online, is that they're saying this is self-inflicted.
Yeah, it's like shooting yourself in the foot. Now, what Trump, the question is what the goal is with these tariffs. So if the goal is to reshore industry, that's going to take a long time.
We had Dan Ives from Wedbush sitting in that chair right there telling us an hour ago that he spent time in Taiwan. He's seen the way that these devices are made. He's seen the factories. He said that's not happening in New Jersey.
No. And it would take forever to do. I mean, there's a reason why they moved there in the first place as well. And so if we want cheaper goods, that's part of this. There are a bunch of different things that go into the creation of our economic flow. This is like, what are we trying to do? Are we trying to change the behavior of other countries? Are we trying to change the financial system itself? What's the goal?
I also think of, if I were running a business, would I necessarily start building a factory in the U.S. and completely pull my operations from offshore, only to then have potentially these tariffs reversed slightly, and then you already started building? Do you think that?
That's a good point.
Is that?
This is going to all be in the earnings reports, because what you do if you're a CEO right now is sort of stand pat. So growth is going to be more challenging. The idea of expansion becomes, should we or shouldn't we? I mean, you have to realize that there's a reason why manufacturing moved to Malaysia, it moved to Vietnam, and that's because China has become more expensive, because as economies grow, their employees expect more pay. So they go to the lowest producer. So the idea that we're going to bring everything back here, that's a multi-year project with dubious results and flies in the face of capitalism as we know it. If the idea is to get countries to change their behavior and negotiate with the president, then we'll see what we can do.
Mm-hmm.
So when Emily came over here 20 minutes ago, the S&P 500 was in the green. It's now down 0.8%. Why is there such a lack of conviction directionally with today's trade?
Because we don't really know what's going on. There was conviction
based on something the White House poured cold water on.
Oh, yeah.
There was a tweet.
There was conviction when we came in and we were down 4% right away, or whatever it was. And then there was conviction on the upside, because what that leak was something that the traders have kind of been expecting. So that kind of played into their priors, and suddenly it just went whoosh. Everything went up. But right now, it's hard to know where we're going to go next.
What you're referring to, it is actually the most read story on the Bloomberg terminal in the last hour. I encourage everybody to go check it out. Jess Metten, Bailey Lipschultz, Esha Day. It's called This is Madness, the 15 minutes that rocked stock market desks.
We got to get these people on. At just after 10 a.m., shouting erupted on the Seabird trading floor in downtown Manhattan. I won't read the rest of the story, but that is the top sentence.
It's kind of wild.
We were going through it as on the team as it was happening. I mean, it was happening all around us, and it was wild.
Go ahead.
Well, I'm wondering, I mean, you've obviously seen a lot of market downturns, a lot of single day crashes. How does this one compare to history when you think about this sell-off seems to be all focused on one very specific event, whereas I don't know, I think the financial crisis, obviously there wasn't just one headline that traders were all counting on or waiting for, but this is so specific to just one.
So the scary thing with crashes is when credit is heavily involved. When you have your traders concerned that debts aren't going to get paid off, or that rates are just tumbling or rising. This is not a credit meltdown. It's an equity meltdown. And it's because stock prices went way up on AI speculation. And then if growth is going to be pared back, which is what tariffs would probably do, then you have to take out some of this. So it's not as scary, I would say, as when you look at the global financial crisis in like 08, 09, there was a sense like the knife was going to keep falling. And if you grabbed it, it was going to slide right through your hands and slice your hand off. This is not that kind of thing. This is more like it actually could be stopped by one guy. Like that's different.
A weird thing happened to me this weekend, Eric, and it was when I was with a lot of friends who were about my age, we're kind of getting close to middle age, not thinking about retirement, but people who have kids, saving for college, that sort of thing. And they started talking to me about the stock market. These are normal people who don't work in the industry. I have a good friend who's trying to sell everything right now because he is scared that something fundamentally is shifting in the economic landscape. He's the second person I've talked to who's expressed concern to me that those words, this time is different. What would you say to those folks having studied other crises?
I would say that they're the contrarian indicators. That's actually what we want to hear. It's the same thing going up. When the famous story is Sidney Weinberg, who at the time was the head of Goldman Sachs, getting tips from his shoe shine guy, and he walks back into Goldman and he's like, sell everything because this is just going to be a nightmare. And so when you start seeing people who normally aren't engaged with this stuff having very strong convictions about where things are going to go, they tend to go in the other way. There really isn't a systemic problem here. That's the thing.
It's not a systemic problem, he argues, with the markets. He thinks it's a systemic problem with globalization and with the president changing the world order that he grew up with.
I just don't think that Wall Street is ready to give up the global order. And the global order is global. So it's not just Wall Street. China doesn't want to give it up. So people want the financial markets. They want the financial markets to work. And the question is how and when that will start happening. But I don't see us reordering away from capitalism because even in the trade landscape, you have other countries that are trying to band together to create trade alliances on their own without us. So this genie is out of the bottle.
Eric Weiner, good to see you. Thanks so much for joining us. Really appreciate you taking the time today.
Happy to be here.
This is the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Lacrosse Asset Team spent all weekend working on it. It's about how Wall Street is just collateral damage in Trump's trade war. Bloomberg News cross-asset reporter Isabel Lee is part of the team that worked on the story. She joins us here in the Bloomberg Interactive Brokers studio. Isabel, congratulations on this story. I know a lot of work went into it. I just want to start big picture. The investor class, it was a class that I think was served well under the first Trump administration. It was optimistic that it would see the same this administration, and it's not at all happening.
Yes, exactly. We actually missed Emily. If Emily was around, she would have been part of this story. But
she was on vacation.
Emily and I were our seatmates, and I bug her way more than I should have. But so exactly, and this is what you call the wealth effect. You know, the past 2 years, investors were all feeling flush. You would check your 401k every single day because markets were up. It's up 20% for back-to-back 2 years. And then now, please don't check your 401k because we're seeing the reverse wealth effect. And a lot of the people that we talked to over the weekend were saying that this has real implications. It will ripple throughout the economy because if you see your stocks or whatever your investments edging lower, it will really impact how you behave. You won't spend enough. Maybe you'll hold off from that appliance. You'll hold off from that vacation. And companies will also maybe lower their capex. And at the same time, there could be an argument that, you know, only 50% of Americans own stocks, but that's still half of the country. And for those average Americans, their portfolios on average are just around, their retirement especially, around 200,000+. There was a study on that. And 20% of that is still significant. It's 40,000. And that is your entire nest egg. We're not even talking about billionaires like Elon Musk. It's the normal average American. So it affects you.
What was the general vibe of the portfolio managers, hedge fund investors that you spoke to over the weekend? Were they angry? Were they confused? Were they looking for opportunities in the marketplace?
Definitely angry, definitely frustrated. And Jay Hatfield, CEO of Infrastructure Capital, was saying actually that he wasn't that much frustrated with Trump. It was more Scott Bessent because they were expecting more from him, given that, you know, he came from the industry. But some were also really shocked because I think this was above what a lot of people expected. This was so-called worse than what they expected. And then what do? They say you get over it and then you adjust your portfolio.
In terms of assets that the president watches, we know he used to like to talk about the Dow and the S&P 500 and equity market records. You and the team write about different assets that he's got his eye on. Bonds, especially, or treasuries, I should say, and then also on commodities.
Yes, there's that. And actually, that's new because usually before it was just the Dow that he was really looking at. And there were reports over the weekend that even Fox News removed the Dow ticker, which was a first in history. I read that, but I need to fact check, so I probably shouldn't have shared it. But it's out there. But now Trump is also looking at 10-year treasuries and oil. So as stocks created, those also moved violently. They sank, basically. And he's also looking at that. But we also have him saying that the patient has lived. You know, this is short-term pain. But you can interpret that phrase in many different ways.
Isabel, you've done a lot of work over the years about the wealth effect and how it's this idea that when the stock market goes up, people see that their portfolios are doing well, so they feel good, and then they go out and spend. And you wrote in this piece, the rich who own most of the shares, most of the stocks, that 10% class that you mentioned, Tim, also account for roughly half of the country's consumer spending. And I thought that was really interesting that, like, these people that wanted Trump in office because he would support Wall Street also are a big part of consumption. And now I guess the economy is getting a double whammy.
Exactly. I mean, not to get into politics. Also, I can't vote. I always tell Emily that. But it's interesting because these people are the ones who are driving much of the consumer spending. I mean, maybe the average American, they're finding it tough. Every time I go to the grocery, I'm just shocked at my bill. But the rich people still buy. I mean, they still buy jewelry. They still buy gold. You see them still buying Lambo, which is like a joke we say in the crypto world. But they're still out there spending. But maybe after this weekend, they may not. But yes, you're right. America is largely a consumer-driven economy, and one can't really doubt whether, like, I feel like you can't ignore this anymore. They will be affected, no matter how rich you are, probably. Or, I mean, maybe I wouldn't know.
Isabel Lee, Bloomberg News cross-asset reporter. Always great when you join us. Check out her story. It's among the most read on the Bloomberg terminal. It is today's big take. Wall Street is just collateral damage in Trump's trade war.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg terminal.